Are you looking to get ready, be prepared, and transform your financial future? Then you've come to the right place. This is the Get Ready Money podcast with Tony Stewart, where Tony has insightful conversations with financial experts who are changing the way we think about money. Catch up on the latest financial trends and hear practical advice from Tony and his expert guests so you can build healthy habits that work. Be empowered with tips for implementing small changes that can have a big impact on your financial future. So sit back and get ready to hear from today's guest.
Welcome to the Get Ready Money podcast, changing the way we think about money. I'm pleased to be joined today by Derek Notman, Dick Weber, and Adam Holt. In this episode, we'll be discussing how we can help life insurance agents and financial advisors succeed. This is an especially important conversation for two reasons. In the coming decade, 106,000 financial advisors plan to retire, or about 37.4% of the industry headcount, according to the latest Cerulli U.S. Advisor Metrics Report, if I pronounce that correctly. And in the insurance industry, the National Association of Mutual Insurance Companies says over the next 15 years, 50% of the current insurance workforce will retire.
Yeah.
And then point two, Derek, as you pointed out in your recent article, which is what spurred this episode, the industry faces a stark reality. Between 72% and 90% of new financial advisors fail or leave the field within the first 3 to 5 years. The numbers are even worse for the life insurance industry. According to Investopedia, where more than 90% of new agents quit the business within the first year. The rate increases to greater than 95% when extended to 5 years. So between those two figures, we're looking at a major issue. So Derek, Dick, and Adam, thanks for joining us on the Get Ready Money podcast today. So, let's start off with a quick round of introductions and your origin story in financial services. Dick, you want to start us off?
I guess the most noteworthy thing is that this is my 58th year in the life insurance industry, to which I always have to say, yes, I was a child agent. So about 25 years as a successful agent, 10 years in life insurance company senior management, and the last now almost 23 years, I work strictly as a consumer advocate. You see my little logo over my right shoulder. I'm a certified insurance fiduciary. We do not sell product. We do not receive commissions. We work strictly as a financial planner would by the hour, trying to help individuals and businesses get the most from whatever it is concerns them about their insurance. I started as a senior in college looking for a part-time job, wound up in a life insurance agency internship program, and surprisingly, it took.
Dick, thanks for being here. Derek.
That's a really cool story just to hear from you, Dick. Thanks for sharing that. I don't have nearly as much experience. I'm just jumping into my 20th year now. Cut my teeth at New York Life. I literally posted a resume on monster.com, and one of their recruiters headhunted me, and they didn't even want to hire me because I didn't know 200 people. So
that's right. I forgot about that.
Yeah, man.
I thought it was 100.
Well, it was like they called it Project 200, and I had so I ended up finding a country club list and just started writing down names saying I knew them. So but I had a lot of success. Ended up being the top NAFA advisor in my first year, and went on to have a lot of success there, and then left. And now, like Adam, I joke I'm a recovering advisor. I still have an RIA, but I'm focused heavily on my fintech company, Coupler AI, where we're fixing lead generation for the insurance and wealth management industry. So a lot of fun, but a lot more to learn too as well.
Fantastic. Adam.
All right. I gotta compete here. So, all right. So I've got 26 years. I think like Dick, I got seduced into the industry. I went to a job fair when I was working for the government, sick of working for the government, and said, I got to do something much more entrepreneurial. And I wound up meeting a financial planning company. Little did I know I became a life insurance agent and had to sell life insurance. I had a Project 100. We had lower bar than you, I guess, at New York Life. I was with Equitable AXA at the time. Still affiliated with them 26 years later. Had a great experience. Wound up loving the life insurance business. Got picked up by two of the top producers in the entire country, and we wound up building a firm together for high net worth. So my experience in the life insurance world was building ultra high net worth mega portfolios for very wealthy people, and trying to piece those together and build what I think what a very small niche market has done. And over the years, I created Asset Map, which I'm known for now, which is a financial planning experience, conversational planning, which gets everybody's all their financial instruments on one page and then gives a diagnostic so that the advisor can apply their advisor intelligence, not the artificial intelligence, the stuff that really matters, right? How do you be more human in a increasingly tech world? So I love the industry. Been involved in MDRT, FinSec, Gamma, and speaking around the country and the world for them as well.
Fantastic. Well, welcome, Adam, as well.
Thank
So, before we jump in with the first question, you guys brought up something that I think has a lot to do with why people have a hard time entering the life insurance industry. You talked about Project 100, Project 200. Would one of you like to expand on that a little bit and how that works for new life insurance agents?
Well, from my experience going back 58 years, it was still the Project 100 at that time. But I think the real dilemma of being able to be successful in those first few years and get away from those horrendous statistics is you're having to do so many different things. You've got to be a good prospector. You've got to be a good marketer. You've got to be a good listener. You've got to have a relationship or create a relationship with the customer. Good friend of mine and the best guru in sales and marketing I know of, Maria Ferrante Shepis, talks about life insurance especially as a sold, not bought commodity.
Oh.
And most people don't know how to deal with that. Most customers don't know how to deal with that. And therefore, most of us who might presume to sell insurance products. So I think the challenges are so enormous that there are very few people that can actually make it out the other side. What do you think, Adam and Derek? Surviving to year 10 is an accomplishment, but hopefully by then you've learned a thing or two.
I remember many times where people said, don't worry, for the first 4 years, you will be underpaid. But if you could survive it, you will be overpaid for the rest of your life. And I think that what tends to motivate people getting into the business is a very entrepreneurial mindset, right? The opportunity to make a quality of life that maybe some people haven't gotten the education or they're changing careers is very common, I think, in the insurance industry. But absolutely, Dick, the product of life insurance is an unknown. It's not a lovely topic, I think, for unless people have actually gone through the event where you didn't have coverage to motivate you to want to go out and buy it. But I think that's also a real kind of education gap. We've relied historically on the relationship currency, right? Call the people you know that are going to trust you to actually place coverage. But we're seeing an enormous gap, everybody. There are common advisors today, the fiduciary-minded advisors are not promoting life insurance the way they should be. And they're letting a lot of cars driving around with great engines and no seatbelts. And we think it's epidemic level proportions on our data side.
Yeah, part of that, I think, I'd be curious in your reaction, is the complexity of today's insurance products. I think renders the insurance agent or advisor somewhat impaired at being able to explain how it really works, and the consumer has very little patience for understanding how it works.
No question. Even back 20 years ago when I was starting, I recall advisors printing off a 50-page illustration. And like now you're going to go try to sell this to a customer. They could barely explain the illustration, let alone, the consumer. And the consumer didn't want it. Like, don't tell me how the sausage is made. Like, how does this help me? How is this going to like protect my family? And so it's a real challenge. But you referenced earlier, there's so many different roles. It's drinking from a fire hose. Yeah. And which one do we pick to work on today? And pay the bills at the end of the month. My first year, we were really struggling where I literally went home one day and was looking at old baseball cards I could sell just to pay our fuel bill. it was a really tough time. And so the complexity doesn't make it any easier. And do we really need to make life insurance that complex? I don't know. I don't know if that's even necessary.
It probably isn't necessary, although you have this dichotomy between term, which most people should have a lot of, and the so-called, we used to call it permanent. I now call it cash value because a universal life is not necessarily permanent. But there's a much smaller subset of people who truly have the lifelong need for the death protection. But now these products are being sold as an accumulation device. It's a better than Roth kind of deal. And I think that's created all sorts of problems. What have you guys run into there?
Definitely seen that. They used to call it like the Roth IRA on steroids, or, just, I think it's a bit misleading. Does it have those benefits, and can it be structured to work that way? Yes. But is it something that every single person and their brother should buy? No. And I think one of the challenges I always saw is that they tried to sell the benefits of the policy from a cash value perspective before the death benefits. And at the end of the day, you buy insurance to protect against that catastrophic event that might happen at some point.
Yeah, that's true. Sorry, Derek. Yeah.
No, go on.
The reality about you, when you have a product like this that there's clearly you can sell the solution or you can sell the problem. If we haven't done an appropriate needs analysis to understand why you need this in the first place, then clearly it's not appropriate, it's not suitable, and it violates pretty much every fiduciary standard that we owe to our clients and their family members. And we've seen way too many lapses and policies imploding because they weren't funded, they were sold wrong, nobody understood where they bought. And I think, unfortunately, some of the good products out there that actually, if they are funded and actually you follow the plan, that does have the capacity to be a long-term solution, they're just not managed. And I think one of the bigger challenges that we have in our industry is because there's such a lack of knowledge about how the black box works, then people just don't use it right. And so it implodes upon itself. And I think if we can educate consumers and the advisors that are imperative to make sure that they're reminding them, like, why do we meet every year and say, well, here's how your portfolio is doing, but we don't do the same thing for a complex insurance portfolio? That's a mismatch. And it's likely because we mismatch the compensation by heaping it up front. Yeah.
That's the issue. In today's world, an insurance agent or typically broker can arrange to get 100% of all the commissions they would ever earn up front. So there's not even that built-in motivation to go back and talk to the client. Adam, from your area of the country, there's a white paper out of Wharton that was written in 2016. It was reaffirmed in 2021. In which it was determined 88% of all universal life type policies will fail to terminate as a death benefit.
Wow.
That is, if it were only half that much, it would be astonishing. But 88%, that really ties into what you were saying.
Absolutely.
So, I have a question, because what occurs to me is that we talk about managing policies, and one of the issues is that, you do have some agents who manage policies, but when we look at the statistics of the amount of agents that leave the business, so think about, that 95% and how many insurance policies they do sell, that they don't really know what they're doing because they're in their first few years of their career. That we have this huge unmanaged block of business. Is that part of the impact, like getting into life insurance?
Well, that certainly leads to the 88% statistic about lapses before death. Is the agent up front is very enthusiastic about whether it is actually satisfying a need or pushing on you something sort of like the iPod. I didn't know I needed that, but now I have to have one. So these very complex products that if they're not being serviced, they're just not going to be kept.
Sorry, Derek. Yeah.
One thing we've written about at Coupler is that these orphan blocks of business, they're really profitable. In fact, they're probably the most profitable block of business the insurance company has. And so what's the incentive to go get new agents to go service those contracts? The insurance company would rather have the contract fail than go all the way to death. Right.
Maybe we could explain that with the lapse ratio, Derek.
Well, that was the basis of this 88% statistic, is that the title of the paper was lapse supported life insurance, that carriers, notwithstanding the intention of regulation in the mid 90s, lapse support, so that the few policies that sustain are being sustained by the many policies that lapse early and leave profits on the table.
It's like an annuity situation, right?
That's what it is.
It's the same kind of math formula almost.
I'm on the board of a reinsurance company, and we look at this, good amount. That understanding the persistency and the lapse ratios is really critical to understand the profitability of the business. And when you have advisors who are mindful of service, then the insurance company can actually create significant profits by keeping the business on the books and keeping that persistency high. In other words, continue to pay premiums into these policies. And it's unbelievable actually how much the cash value contributes to the overall profitability, especially as you move more towards the variable side of the business or the universal side versus whole life. I think the interesting thing, going back to, your comment on retention in the business, in other words, the success rate of advisors, think about it this way. Very few insurance agents are ever taught how to service a book of business, only to sell it.
Right.
And so you're taking somebody who's entrepreneurially trained to actually place new business and continue to hunt and refer and generate new business, and never teaching them how to service other than asking for a referral. And that's kind of the crux of why I think we're in the state we're in with this business.
Well, it sounds like there's a conflict of interest here between the insurance companies being more profitable if they have these orphan policies that are not being serviced. So is that part of it? Is there an incentive for the insurance companies to keep this agent turnover rate the same?
Well, that's a tough one, because it costs anywhere between $300,000 and $500,000 to train a new advisor in the first 3 to 5 years. So unless they write a ton of business, they are not going to break even on that hire for years.
Well, and remember, when you're talking about training, you're talking about a relatively limited number of insurance companies today.
Yeah.
So your old line mutuals, Mass Mutual, Guardian, New York Life, Northwestern Mutual, a few others, they're the ones who still have the agency forces. They spend a fair amount of money training. My concern is for the vast majority of what we now call producers, no longer agents or brokers, but producers, who's training them?
Yeah.
That's virtually none.
Oh, sorry.
Yeah, it's a great, actually, we did a survey in 2020 into the pandemic. Asset Map held a study of the 20 insurance companies that still had an agency development or a new agent development program. And Derek's right on. It was $225,000 on average to get somebody to their fourth year, because one in four made it. And that was with strong numbers of almost 20% retention in 4 years.
Wow.
Who knows? The current numbers are probably worse, but you have seen almost all of these companies move to an assets under management model, because they recognize they can make much greater profitability from selling term insurance to actually selling assets under management with all the securitization that goes on in that business. So it's interesting to see. I would be really surprised if a bunch of the life insurance manufacturers stay in the true life insurance business. We've seen a bunch of them start to migrate into niche markets only because they can't find profitability in the insurance market.
Well, in my career, when I first came in, anecdotally, there were 2,700 life insurance companies. Today, there's anecdotally 900, but there's a lot of small regionals, fraternals. It's probably only about 100 major carriers. And we're in the process of losing Phoenix Mutual Home Life, that combination.
I thought they were long gone.
MetLife to
No,
Bright
they're
House,
just all
and now
lawsuits.
Bright House is trying to unload what they've got.
Yeah.
So consolidating very rapidly, Adam,
Absolutely.
you're absolutely right.
Yeah, well, before we move on, I was wondering if somebody could quickly define lapse ratio for our listeners and what that means, lapse supported.
Anybody could do it. We got an hour.
Right. Dick, you want to just do a quick definition?
But when you say lapse ratio, you're referring to like my statistic of 88% of universal life policies fail.
Yeah, and lapse supported.
Well, lapse support is where in your illustration, you assume that the buyer is going to keep the policy for a certain period of time, after which you begin showing persistency bonuses and other things that favor those who hang in there. So that's what gets you to buy in, but most people leave, which leaves the money on the table to pay
Yep.
the few people who have stayed. How's that for an explanation?
Yeah, and as part of
That's
that,
interesting.
too, is I think where Adam was going is, and Adam definitely jump in, is that the insurance companies count on a certain number of policies lapsing each year,
Mhm.
because when the policies lapse, they don't result in a claim. And so I think that's part of it too. But let's talk a little bit deeper about the field force. And we haven't really talked about financial planners because I think they're related because a lot of life insurance agents are also financial advisors. They may not be certified financial planners, but I think a lot of them are
Yeah.
doing double duty. Is part of the reason why so many people are leaving. Is it retirement? Is it a graying? Is it there's a greater issue at heart with running a life insurance or financial advisory practice?
Yeah, I got an opinion about this. I mean, one of the things that I think was strong about the life insurance industry is they were much better teaching. They taught fact finding better than any other industry. You
Yeah.
had to understand the client and their family and the interdependencies of those people had, we'll call obligations to them, because that's where you sold the problem, right? And ultimately the solution would sell itself, right? How are you going to take care of your family? How are you going to pay your debt? It's interesting to see how the wirehouses trained their people to say, well, let's look at the statement and let's find inefficiencies or fees and let's just manage a portfolio. And both of them found a way to come to financial planning as a sales enablement process to still distribute exactly what they always sold. And what I'm basically saying is that if you're a good fact finder, you can sell anything. And I think thinking about how financial planning has evolved, what I think's happened in the insurance business is all those people who were in the insurance world realize they can annuitize their income and basically get paid every month by just starting out the month with positive cash flow. I didn't have to go find another person to sell whole life to. That changed the game. And I think what's happened is a lot of advisors have forgotten how to sell. They've forgotten how to approach. They've forgotten how to talk about difficult things. And as a result, that's why I think we're seeing, gentlemen, an epidemic in terms of the lack of coverage relative to exposure in families.
It's been
Yeah.
interesting that New York, as you probably know, a couple of years ago, passed a regulation, illustration regulation 187, that imposes, while they do not use the word fiduciary, they impose all the words that define what a fiduciary must do as to suitability and best interest. And what is so interesting about that is the agent organizations have been fighting that like mad. We tried to introduce something like it in California, and that immediately got trounced upon by the industry. Sorry, nothing like your phone ringing through your computer.
We don't hear it.
So there's a nascent attempt to professionalize, as the CFP world is professionalized and certainly has been under a fiduciary obligation since 2008, to professionalize the life insurance industry. And there's tremendous resistance to doing that. And at the same time, as we've all been talking about, there's a big reduction already and projected in the future of insurance agents. The one thing I would want to make mention of is we do a lot of expert witness work. And of the 15 cases we currently are working on, hopefully they don't all come to testimony at the same time. Most of them involve these very complex products, and most of them were sold by non-traditional professional life insurance agents. They are IARs and CFPs and otherwise financial planners who have insurance license, and they think they know it all and they don't. And it's causing a great deal of harm, which is hurting the life insurance industry. What do you guys think about that?
Well, the CFP, I got it when I was still a life insurance agent, and I had my ChFC before that.
Right.
And Did I learn how to be a better advisor and be more comprehensive and all of that? Of course I did. But it was a great marketing tool.
Mhm.
Right. And I think what we've, as Adam alluded to as well, is that we've now shifted. The pendulum has swung so far to the other side now that now we're getting really deep on the comprehensive side, but we have no idea how to sell a life insurance policy appropriately. And it is creating a massive problem, whether it's confusion in wrong product or no product at all. It's interesting because we got it. The CFP made it easier to sell life insurance in a sense, right? Because there was more credibility,
Sure.
and so forth. But I don't know if that's actually helped. I almost feel like the CFP should be like the head coach of the team, and then let's get specialty players to fill each role.
That's been something. I'm on the Standards Resource Commission of the CFP board, and that's something that we're really focusing on right now. Is the typical CFP may be able to get to the point of being really good and proficient at 2 or 3 at most areas.
Yep.
Yeah.
So investing, maybe taxes, maybe retirement income, whatever it might be. But the consumer, especially the affluent ones, they need this much stuff, not that much stuff. And
Yep.
so we already are used to bringing in the attorney, the accountant, et cetera.
Yeah.
And what we're trying to say to the CFPs, if insurance is not one of your top areas, you need to bring in an expert. How they get compensated is another issue, but the customer deserves the expertise.
Definitely.
Yeah, there's no question. And with the amount of, I think, especially in the ultra high net worth space of permanent policy that's out there, as well as premium finance that become obviously such a big deal. So many people just, they bought into a concept, they bought into a premium structure. They think it's going to set. It's not happening. We've seen a lot of kind of IULs, index universal life contracts that have these incredibly low sustained crediting rates. People don't remember that. They're like, the stock market's up 20%. Why aren't I up? No, you're up 6% on a general account. And they don't even know to understand it or to find out why, and they don't test it, and the agent doesn't call them. So
They think they're in the stock market.
yeah, right. I was told I'm going to participate in whatever the stock market is. I never lose any money. So, the marketing that goes on around this nonsense is really, really hurts the business. But the reason it doesn't change, gentlemen, is because there's just so much money flow in the current infrastructure that people aren't willing to walk away from. It's the reason why we can't change the regulations. And it's the reason why ultimately the consumers are going to need a fiduciary responsible advisor to tell them what the heck they got.
It's interesting in New York, the FinSeca, who is the old AALU and a bunch of other organizations, they have really been coming down hard on the New York rule because of the statistic that something like 7% less life insurance was sold in New York the first full year the rule was in place.
Mm-hmm.
And so their theme has always been, if you impose any restrictions or obligations on the advisor, that simply gives less facility to the consumer to have access to insurance. And we said, well, that's interesting, but maybe it took 7% of the real abuses out of the system. And maybe that's why a little bit less insurance was sold that first year.
Definitely.
Yeah.
Well, I think one of the things I heard and I think really makes a lot of sense is that there should be somebody sort of overseeing it, a head coach, and then you have your different products that you slot in. And I think we forget that sometimes is, estate planning is part of a financial plan, insurance is part of a financial plan, tax planning is part of it. And there's a few people I think who are brilliant enough to pull off all areas, but I've seen it executed very few times. I mean, Adam, that's really your thing. Asset Map is taking a look at the whole thing. Do you think a tool like Asset Map, I mean, of course, we want to plug Asset Map and say everybody should have Asset Map on their refrigerator, which is where I heard somewhere. Is something like Asset Map, is that a solution?
Well, I think what Asset Map really tries to do for advisors is to not be judgmental. It's not to say that you should buy life insurance. And actually, the entire model never talks about insurance. It says you're short capital. if this event happens, you're short capital. Now, do you want to finance it? You want to try to save? You want to borrow it from mom and dad? Do you like, it doesn't matter whether you're retiring, disability, long-term care, loss of life. This is just financing decisions. Now, it might make sense mathematically to go buy some cheap term, or maybe it makes sense to have a long-term solution. That we leave up to the professionals to decide with cogent advice and thoughtfulness, because every situation is different. But it is interesting to see what kind of capital shortfall we're seeing on the data side. With over 2 million people in Asset Map, we've seen this: about 800,000 households have been visually mapped, so full financial inventory. It looks like 50% of those clients who are working with a financial advisor, by the way, that's how they got the data into Asset Map. 50% of those households couldn't handle 3 of the six events that will disrupt them, like loss of life, disability, long-term care. They can't even handle it financially. Nobody's asking these questions. And so if we're doing anything at Asset Map, is we got to be teeing up these conversations so that you can make an intentional decision of insure, don't insure, right? That's where we need to get to. It's not about which insurance to buy.
Yeah.
It's, you don't even know to have the question, like, or to have the conversation.
You're facilitating conversation is what you're doing. And that's the key. That is the key.
Yep.
I teach risk and insurance at Texas Tech, Cal Lutheran, even at Berkeley, to young budding CFPs. I mean, they're aspiring to be CFPs. And what I say about risk and insurance is, first, you have to look at the risks. You have to find out what the sensitivities of the customer are before insurance, which is really transfer, is even appropriate. But at the same time, we are all insuring every risk that could possibly come upon us. Whatever it is, the things we know about, the things we don't, we are insuring those things. It's self-insurance. So let's be conscientious about deciding of the 3 major, pick a number, 3 major risks. If you're self-insuring, there's nothing wrong with that as long as you're conscious about that and choose to do that. I think, Adam, that plays exactly into what you're saying.
100%.
So, to start to wrap up, let's talk about what we can possibly each do to help. And I think, Derek, I definitely, would like you to take the lead on this, because it was your post that kind of really got us thinking and talking about this is what can we actually do to help? I mean, Coupler AI is definitely a solution in this area.
So for me, because I'm an advisor still too. So at the end of the day, we are in a people business. It's relationships, it's rapport, it's establishing trust. Money is super personal and private. And if we're going to open up with an advisor, we have to have that level of trust and communication. So when I look at the technology landscape out there, we need to look at technology that facilitates better human connection instead of trying to replace it or, so forth. So I think that's really, really important. That's what we're all about at Couplers. We're facilitating great human connection, because when we can have that connection, then you go downstream to like an asset map experience, and now you can have great conversation around everything. And then that makes the consumer feel empowered. And when they're empowered and educated, they can make better decisions. And you just keep doing that over time. I also think the other thing that needs to be dealt with in some way, and I don't know how, is the compensation structure around life insurance products. It just does not, like I met with a client today, and we were talking about my New York Life days and my transition to independence, and talking about, and they were actually in a sales role at a bank. And they're like, sales quotas suck, right? Because it puts this pressure and this conflict of interest on the advisor to sell versus, for their company and their own wallet versus what's best for the client. So I think doubling down on human connection with technology, but then trying to figure out a better way to, advisors should get paid. We do really, really valuable work. We're really important to society, and the products we serve are important to society. But the way that that's comped, I think really needs to be challenged and looked at.
I totally agree with that. My approach, and it's a cottage industry of approximately 3 people, of being fee only when it comes to insurance expertise, and then working with that customer's agent or advisor to accomplish what it is that we worked on. I think separating those 2 things out for me, and I think my clients, has had a great advantage. So you guys have worked as CFPs with customers. Have you always handled the insurance piece, or have you referred it out?
Is that a question?
Yeah.
Yeah. So when we deal with mega portfolios, there's almost always a family office and a secondary fiduciary involved. So $100 million or up policies, but not for, not for rank and file, not for policies even that are 20, 30 million. You're in a shopping game. And I think that's one of the bigger problems, is that we're a premium centric product as in insurance, right? People look at the death benefit, they look at the lowest premium, they see the A rating or not, and that's it. That's good enough. And they just hope for the best, right? You just sold me the cheapest product relative to benefit. I happen to think, for the two of you, Derek and Dick, that this is the challenge with this, is that I really find it hard. We've been talking about levelized comp for such a long time, and unless the client is paying it directly, the question is, why can't the carriers pay it? Now, in the insurances that our firms are still writing today, we choose levelized comp whenever it's an option. The
But
reason
it
is
doesn't
because we know
change the benefits under the policy typically.
it shouldn't. Obviously, if it does, then that needs to be disclosed for sure. But the point is that if advisors were given the option, the challenge, as we all know, is that in the early days of your existence, you got to put food on the table, as Derek said. And really, the reality is that since most people fail, the entire deck is actually skewed against success. So you basically use all your relationship currency to get your family in there, sell them a bunch of insurance, and then you leave. And basically, the insurance companies, and I love them, but they're basically just taking all the cream off the top and then hoping you survive. And I think until we get to a place where we can pay agents a salary that they can replace with levelized compensation over time, we're still going to have this problem next year and the next year.
There was a carrier about 10 years ago who came up with that very idea, and they put a lot of effort into creating. They saw accounting majors graduating from college as being the ideal people to bring into a quasi master's program. Will pay you a decent salary for 2 years to learn everything you need to know about life insurance, and then you be able to go out there and really be strong, not just the knowledge of the product, but how to sell and all those other things. And they were just about to pull the switch on that when someone said, well, what happens if after 2 years, some other major company, maybe the one in Milwaukee, we won't name names, would co-opt those graduates of our program, and that canceled the program.
Yeah, oh man, I believe it, because that's probably what happened. You're going to train my people and they'll survive for 2 years. Fantastic.
Exactly. Yeah, right. Great. I'll take that all day long. Right.
Yeah.
Look,
well, on that, I was chuckling because back in 1995, I co-authored an article for AM Best talking about how there was an imminent move to level commissions in the insurance industry. So that's been one of my worst calls 30 years ago. Still hasn't happened. So
that's right.
You look it up in AM Best.
Yeah, that's true.
I like Adam's approach. If we could get it to be optimized from the customer, is for the agent to choose a levelized compensation system, and as long as that favorably impacts things like surrender charges and other things, then that helps the agent differentiate themselves in their marketplace.
Sure does.
No so question. To wrap up, let's do a quick round of your number one takeaway from this episode. Adam.
My number one takeaway is that all advisors should be thinking holistically and should actually approach, I think, this insurance business as if they were in the car with the family, right? If you're in the car with the family, you pay attention to making sure that the brakes are checked and the air tire pressure is not. We're not just selling them something and then sending them on their way. We got to be present throughout this whole process, and I think that means we need to make a commitment to anyone that we think we're taking care of financially to ask the tougher questions, and I think that means doing the analysis around insurances, even though we don't necessarily, that may not be our strong suit. So if you're an advisor listening, please make sure that you ask the question, what's the plan to deal with a loss of life, even the other insurances that can be used to solve those problems. And I think to Dick's point, I think the great takeaway is by default, you are self-funding. The question is, does it make sense to push off that risk based on your cost of capital and your priorities? And I think that's a great way to frame it going forward.
Fantastic. Dick.
Um, Insurance agents fail for lots of reasons, one of which is their own self-image about being a life insurance agent is about the same as selling used cars. So my approach has been for years about voluntarily adopting a fiduciary standard.
Yep.
And I put it in a phrase that I've always loved. I saw it on a stitched hanging once. When they're running you out of town, get at the head of the line and make it look like a parade. And I think that's what today's agents should be doing, is adopt fiduciary because it's not required and offer it as a benefit of working with you.
Great tip. Great tip. Derek.
The life insurance industry really is a blue ocean, but I think just advisors in general, whether you're selling insurance, investments, whatever, I think you need to focus a little bit more. Don't try to be the one-stop shop that does it all. I so many times in my early years, I would see advisors, insurance agents fail out because I'm going to sell whole life, but I'm also going to sell annuities and mutual funds and 529 plans and Medicare supplement plans and blah, 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 blah. And next thing you know, you're a master of none. And so it's okay to be a life insurance agent and be a really good one. Don't feel like that's like a used car salesman position unless you are really that cheesy car salesman, but it's okay, or if you want to be a fiduciary advisor, then go do that. But just, I think, pick and focus and know that there's a lot of opportunity there and know that it's going to be really hard. I don't know if we're ever going to get, I think we can move the needle from 9 to maybe 8 or 7 out of 10 fail. But that's going to take a lot of moving pieces to come together. And so just, I would say, get focused, look for things that make your job a little bit easier, like human-centered tech, and just be really, really good at what you want to do.
That's great advice. So just where can people get in touch with each of you, hang out online? Adam?
Yeah, I hang out online at the corner of LinkedIn. And
I guess maybe that was
what
the
are
wrong
you
word.
talking about, Tony?
Yeah,
LinkedIn is the best way.
that.
Yeah, LinkedIn is the best for me. It's H Adam Holt. If there's an H in front of my name, just to differentiate from myself from all other Adam Holts.
Humble.
But yes,
Humble.
you can humble. That's right. H Adam Holt, and of course, asset-map.com is the place to find everything that we're doing.
Fantastic.
And my
Dick.
website is insurancefiduciary.com, and my email is dick@insurancefiduciary.com.
Fantastic. And Derek?
LinkedIn is great for me as well. And then also the website Coupler, COUPLR.ai. We dropped the E because we're a tech company. So
It's searching up all these tech companies, so it can always be challenging. And for everybody watching and listening, as always, there will be links to everybody's social media profiles and websites in the show notes, so you can easily navigate to connect with our guests today. Derek, Dick, and Adam, thanks for joining us today on the Get Ready Money podcast.
Thank you very much, Tony.
Great job.
Yeah. And
Great
thank
chatting
you
with
all. Yeah. we're wrapping this up. So thank you everyone, as always, for tuning into this episode of the Get Ready Money podcast. If you learned something today to change the way you think about money, please be sure to subscribe and to tell a friend. Until next time, let's change the way we think about money.